I am pleased to bring in Boston Fed President Eric Rosengren to the exchange. Eric, thanks for joining us. Neither of us know when these interviews are booked what the news is going to have been the day before. But in this case, you're the first guy out of the box that we get to ask about President-elect Biden's $1.9 trillion with a T stimulus plan. I'm wondering if you could tell me how you as a monetary policymaker think about a proposal that size.
Well, thank you, Steve. Thank you for having me. Good to be on. It is a big package, but I think it's appropriate. So the economy is in a lull right now. We've had a series of pretty weak data. The last jobs report highlighted a loss of 140,000 jobs and an unemployment rate staying at 6.7%. And if you look at where it was impacted, it really was those areas that are being affected by the pandemic. So it was restaurants and bars were down 372,000 jobs. Amusements and recreation were down 92,000 jobs. That all indicates that we need to do more to support the economy. So while it is a very big package, I do think that until we get to the point where people have been vaccinated, where businesses have been bridged, and where many of the unemployed workers have come back to work, we need an expansionary fiscal policy. And to the extent that it targets those parts of the economy most affected by the pandemic, that is the appropriate action for fiscal policy at this time.
Eric, obviously, as a Fed maker, you have the dual responsibility of maximum employment and stable prices. And so this affects you on the back end when it comes to your mandates. Is it possible that there could be too much stimulus? Is it possible that you end up creating inflation down the road that you have to worry about?
So we can't continue spending trillions of dollars. And my expectation would be, as we get closer to full employment, we would get a tighter fiscal policy. So we do have to consider fiscal policy when we're thinking about what appropriate monetary policy is. But when we're at the zero lower bound, it's a great time to be using fiscal policy, and fiscal policy can target sectors of the economy in the way that monetary policy can't. It's equally important when the time comes for fiscal policy to become more restrictive. We're pretty far from that time right now, but that time will come, hopefully over the next couple of years. But I think that the mix that we have right now, actually on fiscal and monetary policy, is appropriate.
When you look down the road at your forecast and your outlook, and I do want to get to that, does the idea that a large package this size, large relief package this size could pass, bring forward a date when you might think about either A, reducing the amount of asset purchases, or B, even raising interest rates?
So it helps support the economy. The main problem right now with the economy is not that we don't have stimulative monetary policy or fiscal policy. It's that we have the wrong pandemic policy. So too many people are infected, and we're being too slow to get shots in the arm. So last night, it was made clear that they're focused on making sure that we ramp up the number of people that get vaccines. I think economic forecasting between now and September is really forecasting how quickly do we inoculate a sizable percentage of the population. So the economy really is being driven by public health concerns. That's exactly why you look at retail sales, you look at the last employment report. Until people feel safe to travel, to go shopping, to stay in hotels, you're not going to get a full recovery of the economy. And that's really determined by public health.
Let me drill down a little bit into that outlook. And I'm guessing there are two distinct pieces of this outlook. One is the next few months, and then is beyond that when vaccines begin to be more widely distributed. Walk us through the kind of numbers you're looking at for the next few months, and then what happens after if we get widespread distribution of the vaccine.
The next 6 months, I expect to continue to be much slower than we otherwise would anticipate because of the challenges in getting a high percentage of the population inoculated. So I'm expecting a weak first quarter, some improvement in the second quarter, but I'm expecting a very strong second half of the year. Now, that depends on how quickly we are able to bring down the infection rate and get the inoculation going, and that's something we don't have a lot of historical data, so there's a huge standard error about predicting that. But in the second half of the year, there are a number of reasons for why I'd be very optimistic. So we have a situation where the savings rate is above 12%. So for those people that have not been badly impacted by the pandemic, they've had a lot of forced savings because they haven't been able to travel. They haven't been able to go to restaurants. Stock prices are up. Real estate prices are up. I do expect more positive payroll employment as time goes on. And fiscal policy, as we just discussed, is highly stimulative. That would mean that consumption would be very strong. If consumption is strong, the economy will be strong. In addition, very low interest rates mean that residential investment is likely to continue to be pretty strong. And I think many firms are thinking differently about their investments. So all those are second half of the year, I expect to be much stronger.
I have a broader question about markets I want to get to, but you just mentioned real estate. I want a quick question. Somebody who I talked to this morning wanted to ask you, which I think is a great question. If the real estate market is so strong, why is the Fed still buying mortgages? And do you think it ought to get out of that business and whatever purchases it's making go over into treasuries?
So it is partly strong because we're buying mortgages. So the low interest rate environment faced by individuals that are looking to buy a house, you wouldn't have strong residential, but those things are correlated. You wouldn't have strong residential investment if we didn't have low interest rates on mortgages. So this is a time where it's very important that we have residential investment come back strongly. And so I think it is appropriate for us to continue to be buying both MBS and Treasury securities.
Okay, let's talk about the broader purchases that are out there. The 10-year yield breaching what I would call the psychologically insignificant 1% level. Do you think is there a level that you could give us that you think about where the Fed might become concerned about the rising yields relative to what it's trying to accomplish and come in and do some form of operation in order to tamp down long-term yields?
I mean, we're not going to just focus on any one yield. We're going to be focused on what the overall economic impact is. So we do have to think about how quickly the long end of the market is going up and whether that dramatically changes our expectation for the path for the economy. I'd say that the increase that we've seen to date wouldn't be enough to do that. And I would also say that one reason it hasn't moved up more is because we are doing those purchases of long-term securities, both the treasuries and the mortgage-backed securities.
Shepard Smith here. Thanks for watching CNBC on YouTube.